It's a beautiful fall day in 1907. You walk up to your bank to withdraw some money. But when you arrive, the doors are locked. You demand answers, but the bank stays silent. Later, you discover the truth. You're not allowed to take out your own money. Not even a dime. This was the reality for millions of Americans during the Wall Street panic of 1907. And the cause? Two men you've probably never heard of decided to run a get-rich-quick scheme. They thought they could manipulate the stock market to make an ungodly amount of money. But their plan backfired, triggering a financial catastrophe that brought the entire American economy to its knees. In just a matter of days, these two men caused interest rates to skyrocket from 9.5% to an incomprehensible 100%. The New York Stock Exchange lost nearly 50% of its value. Commodity prices dropped 21%. Bankruptcies surged by 47%. Unemployment more than doubled. All because two men, Augustus Heinze and Charles Morse, wanted to make a quick buck. This is the story of how greed, manipulation, and reckless ambition nearly destroyed the American financial system. How a scheme involving copper mines and ice monopolies cascaded into one of the worst financial panics in history. And how one man, J.P. Morgan, quite literally locked Wall Street's most powerful financiers in a room until they agreed to save the country. But this isn't just a historical curiosity, because the exact same pattern would repeat itself a century later in 2008. Different players, same script, proving that the lessons of financial history are never truly learned. Let's start with how America got to this point. Because to understand how two scheming opportunists nearly bankrupted the nation, you need to understand just how fragile the economy already was. America in the early 1900s was booming, but beneath the surface, cracks were forming. The economy was growing rapidly, but the financial system supporting it was dangerously unstable. Banks operated with minimal oversight. There was no central bank to provide emergency liquidity, and trust companies, institutions that functioned like banks but with even fewer regulations, were financing increasingly risky investments. Then came the San Francisco earthquake of April 1906. The disaster killed around 3,000 people and caused an estimated $400 million in damage, over $13 billion in today's money. But the economic impact went far beyond California. Massive insurance payouts from British firms drained gold reserves from the United Kingdom, forcing the Bank of England to raise interest rates. In response, the United States followed suit, tightening credit and putting even more strain on an already unstable system. Money dried up across the country. Banks ran low on cash. Businesses began failing. And in this environment of financial stress, two men saw opportunity. Augustus Heinze was desperate. Charles Morse was swimming in wealth. But they both had one thing in common. They were devoid of morals. And together, they would orchestrate a scheme that would push America to the brink of total collapse. Augustus Heinze was one of the infamous Copper Kings of Montana, and he was no stranger to unethical schemes if they meant profit. He'd made his name in Butte, Montana, a frontier district drowning in copper wealth. When Heinze arrived in Butte, one company had seized control, Amalgamated Copper, a massive conglomerate backed by an even more formidable corporation, Standard Oil. Ruthless and powerful, Amalgamated swallowed competitors and ruled the region with an iron grip. But for someone as cunning as Heinze, this dominance meant opportunity. He didn't want to break the monopoly out of principle. He wanted a piece of the fortune, and he didn't care how he got it. In 1895, Heinze bought the Rauris mine, a property bordering Amalgamated's operations. Then he launched a war on two fronts, one in the courts, one underground. He buried Amalgamated in over 100 lawsuits, tying them up in endless legal battles. But while they fought in court, Heinze's real operation was happening beneath their feet. His workers tunneled under Amalgamated's claims, broke through their shafts, and stole over $1 million worth of high-grade copper ore. Now, you'd think this was blatantly illegal. And you'd be right. But Heinze was too smart for the law. Or, more accurately, he'd corrupted it enough to make the law irrelevant. He twisted Montana's apex laws, mining regulations that were supposed to prevent exactly this kind of theft, exploiting legal loopholes to justify the underground robbery. And if that failed, he had a backup plan. Judge William Clancy, a close ally, who ruled in his favor at every turn. With Clancy's help, Heinze convinced the courts that Amalgamated was an illegal monopoly. For a moment, it seemed like he'd outmaneuvered one of the most powerful trusts in America. But power comes at a price. The endless legal battles drained his resources. As the case gained wider attention, the tide turned against him. Public opinion shifted. Amalgamated's superior legal resources began wearing him down. In 1906, Heinze cut his losses, sold his mining rights, and moved to New York City. It was there that he would cross paths with an even bigger schemer, Charles W. Morse, the Ice King. If Augustus Heinze was ruthless, Charles Morse was something else entirely. He wasn't just a schemer. He was a man who built entire industries on deception, bribery, and fraud. From a young age, Morse leveraged his intelligence without any concern for ethics. It started small. As a teenager, he convinced his father to pay him $1,500 to keep the company books. Then he simply outsourced the job to someone else for $500 and pocketed the difference. His first real profit, earned not through hard work, but through manipulation. As he grew older, his schemes became more ambitious and malicious. While still a student, he brokered deals to ship massive blocks of ice from the Kennebec River in Maine to desperate New York City residents. But he didn't stop there. Instead of sending his ships back empty, he filled them with southern lumber and coal, profiting on both legs of the journey. Through this operation, he made over $100,000 before he even graduated, nearly $3.5 million in today's money. By the turn of the century, Morse had done the unthinkable. He took over nearly every ice company on the East Coast and consolidated them into the American Ice Company, a $60 million empire. That's about $2 billion in today's money. The newspapers crowned him the Ice King. But behind the headlines, his methods were anything but noble. With his ice monopoly secured, Morse set his sights on something even bigger: finance. Flushed with cash, he took control of the National Bank of North America and the North Amsterdam National Bank. He became a major shareholder in the Mercantile National Bank. One by one, he pulled the strings of New York's financial system, bending Wall Street to his will. The stage was set. One man was a mining outlaw, the other was a financial predator, and both were dreaming of schemes that would push the country to the brink. It wasn't long before Heinze and Morse became entangled in each other's ambitions. Morse saw Heinze as a kindred spirit, someone bold enough to take risks, ruthless enough to break rules, and reckless enough to play a game even Wall Street feared. With Morse's help, Heinze rebounded from his Montana losses. He was given control over 6 national banks, 10 state banks, 5 trust companies, and 4 insurance firms. The two became close allies. Once a lone opportunist, Heinze was now Morse's partner in crime. Together, they set their sights on a new scheme, one that would make them unimaginably rich. Or so they thought. The plan was simple and had originally been devised by Heinze's younger brother, Otto. Otto was convinced that many investors had bet against United Copper Company stock, expecting its price to fall, a practice called short selling. If Otto was right, he and his partners could trap these short sellers in what's called a short squeeze. Here's how it works. First, Heinze and Morse would buy as many shares of United Copper as possible. This buying pressure would drive the price up. Short sellers, who had borrowed shares and sold them hoping to buy them back cheaper, would suddenly face losses as the price rose instead of fell. Desperate to cut their losses, short sellers would be forced to buy shares back at the higher price, which would drive the price even higher. In theory, Heinze and Morse could control the supply of shares, forcing short sellers to buy from them at whatever price they demanded. If it worked, they'd make a fortune. But to pull it off, they needed capital, a lot of it. For that, they turned to one of the largest financial institutions in the country, the Knickerbocker Trust Company. And conveniently, this massive firm was now headed by one of their old associates, Charles T. Barney. Barney had been involved in their past financial dealings, and trust companies like Knickerbocker operated with fewer restrictions than traditional banks, making them the perfect vehicle for Morse and Heinze's risky bet. More than anyone, Barney would come to regret his part in this scheme. Unlike national banks, trust companies were lightly regulated. They held only about 5% of deposits in reserve, compared to 25% required for national banks. This made them more profitable, but also far more vulnerable to sudden shocks. And their clients weren't ordinary depositors. They were big players, with even bigger risk appetites. Trust companies played a different role than banks. They loaned large sums directly to Wall Street brokers, who used this money to buy stocks. These loans were often unsecured, no collateral required, but they had to be repaid by the end of each trading day. Brokers would use the stocks they purchased as collateral for a second loan from a national bank. That call loan was then used to repay the trust company by nightfall. It was a daily cycle of borrowing and repaying that kept the market liquid, but was also dangerously fragile. With Barney's help, Heinze and Morse funneled massive sums into their scheme, but they had made a fatal miscalculation. Heinze had assumed they could control most of United Copper's stock. He was wrong. When they triggered their short squeeze, short sellers found other sources to buy shares from. The trap failed. On October 15, 1907, the scheme collapsed. United Copper's stock price crashed and panic set in. The reckless gamble had backfired spectacularly, and now the entire financial system was at risk. The week between United Copper's collapse on October 15th and Knickerbocker's closure on October 22nd was like watching a slow-motion train wreck. As news of Heinze and Morse's connection to Knickerbocker spread, worried depositors began quietly withdrawing their funds. What started as a trickle soon became a flood. On the morning of October 22nd, 1907, the panic truly began. A growing crowd of depositors gathered outside Knickerbocker Trust Company's headquarters, desperate to withdraw their money. Inside, clerks worked frantically, handing out cash to anxious customers. In just a few hours, Knickerbocker paid out $8 million across its 4 New York offices. But it wasn't enough. The trust was running out of money. By early afternoon, it shut its doors to desperate customers. It wouldn't reopen for nearly 5 months. For those reading newspapers that morning, the crisis seemed under control. The Wall Street Journal and New York Times reassured the public that the New York clearinghouse had the situation in hand. Headlines oozed confidence. The financial sector was strong. Markets were steady. There was no reason to worry. But reality told a different story. This was just the beginning. Knickerbocker's failure sent shockwaves through the financial system. A crisis of confidence took hold, and fear spread like wildfire. If one of the largest trust companies in America could collapse overnight, what about the others? What about the banks that had lent money to Heinze and Morse? Lines formed outside banks across New York. People no longer trusted that their savings were safe. The panic wasn't just about Heinze and Morse anymore. It was about the entire financial system teetering on the brink. The panic spread to other trust companies. Customers worried that their banks had made similar reckless bets. As trust companies crumbled, other banks scrambled to protect themselves. They pulled their reserves from Wall Street, cutting off cash to the stock market. The fear became self-fulfilling. Banks stopped lending. Trust companies hoarded whatever cash they had. The halls of Wall Street, once teeming with eager investors and rapid trades, fell eerily silent. As fear gripped the market, interest rates skyrocketed from 9.5% to a staggering 100%. At times, no one was willing to lend at any price. Without credit, businesses couldn't pay workers. Investors couldn't cover losses. Companies began collapsing under the weight of uncertainty. The New York Stock Exchange spiraled downward, losing nearly half its value in weeks. Fortunes vanished overnight. Commodity prices plunged by over 21%, choking industries that relied on stable markets. Bankruptcies surged by 47%. Then came the layoffs. Factories shut their doors, offices emptied. Unemployment, once a low 2.8%, shot up to 8%. Millions found themselves without work in an economy that had completely seized up. What had started as a scheme by two men to manipulate a single stock had spiraled into one of the worst financial disasters in American history. As the crisis deepened, there was no government safety net, no central bank to step in. If the bleeding didn't stop, the entire country could plunge into total collapse. Wall Street placed its last hope on one man, J.P. Morgan, the most powerful banker in America. He had the wealth, the influence, and the experience to pull the country back from the brink. But even he knew he couldn't do it alone. Morgan called an emergency meeting at his personal library on Madison Avenue. The city's top financiers, bankers, trust company executives, Wall Street leaders, all gathered under his roof to find a solution. Tension filled the room. The stock market was on the edge of collapse. Major banks were failing, and no one wanted to be the first to sacrifice their own reserves to stop the panic. But Morgan had no patience for hesitation. According to witnesses, he locked the doors. No one was leaving until a plan was finalized. For hours, they argued and negotiated. The atmosphere was tense, while the rest of the country held its breath, anxiously awaiting salvation. By early morning, a deal had finally been struck. Morgan and his closest allies raised $3 million to prop up the Trust Company of America, stopping another bank run in its tracks. Then, he organized a $25 million rescue fund to stabilize the stock market, lowering the crippling interest rates that were suffocating Wall Street. But that wasn't all. He orchestrated another $30 million in bond purchases to keep New York City running, ensuring public employees received their paychecks. These large-scale bailouts restored some confidence. The situation began to slowly normalize. But here's the thing about J.P. Morgan. He refused to rescue Knickerbocker Trust. He let it collapse completely, as a warning to reckless financiers. The message was clear. If you gamble with the system, don't expect to be saved. As for Augustus Heinze and Charles Morse, they were thrown out of the banking industry. Morgan personally ordered their removal from New York's financial world. Heinze drowned himself in failure and alcohol, drinking himself to death by 1914. His younger brother Otto, whose ambitious plan had set the disaster in motion, was barred from the New York Stock Exchange. Instead of turning to alcohol, Otto disappeared into obscurity. The younger Heinze's scheme had shattered not just his fortune, but his family's legacy. Meanwhile, Morse faced prison for federal banking violations. He tried fleeing to Europe, but was caught and sentenced to 15 years. Prison wasn't the end of Morse's story, though. Behind bars, he befriended a fellow inmate named Carlo Ponzi and took him under his wing. That name probably rings a bell. Whether Morse explicitly taught Ponzi the tricks of financial fraud will never be known, but their time together likely influenced the notorious con man's future. The Ponzi scheme, named after him, would become one of the most infamous financial scams in history. As for J.P. Morgan, he was initially hailed as the savior of Wall Street, but suspicions grew. The public questioned whether he and other powerful financiers had too much control over the economy. A congressional committee was set up to investigate these money trusts, seeking to uncover the immense influence Morgan and his associates wielded over American banking. For Charles T. Barney, the collaborator who helped enable Morse and Heinze's scheme, the collapse was more than financial. After being forced to resign from Knickerbocker, he returned to his Manhattan home on November 14, 1907, and took his own life with a revolver. The man who helped enable the scheme became another casualty of reckless ambition. While Morgan refused to save Knickerbocker initially, the institution eventually reopened in March 1908 after painful restructuring. It never regained its former glory, ultimately being absorbed by Columbia Trust Company in 1912. And in 1914, the same year Heinze drank himself to death, J.P. Morgan also died. He'd exhausted himself from the relentless pressure of being the nation's unofficial central banker. Morgan's power had saved America's economy, but the era of unchecked Wall Street titans was coming to an end. The panic of 1907 marked a turning point. The financial system had outgrown its safeguards, and the government recognized that it needed something it had resisted for over a century: a central bank. In 1913, Congress created the Federal Reserve, designed to prevent future panics by providing liquidity in times of distress. The idea was that there would never again need to be a single private banker locking people in a room to force a bailout. But more than a century later, the 2008 financial crisis followed an eerily similar script, proving that the risks of an expanding, complex financial world only grow larger. Both crises began in New York's financial markets, spreading rapidly across the country and then the world. In 1907, the failure of Knickerbocker Trust triggered widespread panic. In 2008, it was Lehman Brothers. Both institutions lacked access to a lender of last resort. Their collapses sent shockwaves through the system. In 1907, J.P. Morgan personally organized the rescue of major banks. In 2008, the Federal Reserve and U.S. Treasury stepped in to prevent total collapse. The bailout of Bear Stearns in 2008 closely mirrored the support the Mercantile National Bank received in 1907. Both crises reshaped the financial landscape. After 1907, the creation of the Federal Reserve was meant to prevent future panics. After 2008, lawmakers passed the Dodd-Frank Act, imposing stricter regulations on financial institutions. But here's what neither crisis truly solved: the fundamental tension between allowing financial innovation and preventing catastrophic risk. The panic of 1907 proved that financial history doesn't repeat itself, it rhymes. From the ruins of Knickerbocker Trust to the ashes of Lehman Brothers, the lessons remain the same. In the world of finance, unchecked ambition threatens not just individual fortunes, but entire economies. Regulatory systems are always fighting the last war, creating rules to prevent yesterday's crisis, while tomorrow's is already being engineered by people looking for loopholes. Augustus Heinze and Charles Morse thought they could manipulate a single stock and walk away rich. Instead, they triggered a panic that destroyed lives, bankrupted businesses, and nearly collapsed the American economy. J.P. Morgan saved the system, but at a cost. His intervention proved that private individuals had too much power over public welfare. The Federal Reserve was created to ensure that would never happen again. But 2008 showed us that new vulnerabilities always emerge: shadow banking, derivatives, subprime mortgages, innovations that existed outside traditional regulation until they exploded. The pattern is always the same. Innovation outpaces regulation. Risk accumulates in the shadows. Someone gets greedy. The system breaks, and ordinary people pay the price while the architects of disaster walk away. History has the answers. Just rarely learn them in time. Because the next crisis is always being built by people who are absolutely certain that this time it's different. It never is.